the Fed always cuts more than the market thinks. And that's really important to understand, both going up and going down. They cut or raise more than the market is predicting. So the market's predicting 4 by the end of the year. Maybe what if they cut by 6? What if we're talking about Fed funds with a 2 handle? Then that would be by December, January. Not expected, but if the economy really slows down, that's probably where they're going to be. And at that point, the 2-year bill will be all the way down there with it. So start diversifying, moving out the curve a little bit. That's kind of, the message. It's you don't have to do everything at once, and if you wait, you're never going to top tick the market, and if you wait too long, it's too late.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and host Adam Taggart. I welcome you all here at the start of a week. We're very fortunate to be joined by a co-portfolio manager at Real Investment Advice, Mike Lebowitz. Mike, how you doing?
Doing great. Thanks for having me on.
Well, thanks so much for coming on, and I want to give you props for pinch hitting today, Mike. We were supposed to be interviewing Judy Shelton today, and she had an unavoidable conflict come up at the last moment, and you were kind enough to step in. And I'm very glad that you did because there's some work that you've been doing of late that picks up on a theme that your colleague Lance Roberts and I have been talking about, which I described a few weeks ago as echoes of 1999, where Lance is saying that he is seeing degrees of speculation in the market that remind him very much of what we saw during the dot-com bubble. You've actually done some analysis to show that that's not just an opinion. We're actually seeing in the data a lot of similar trends in terms of where capital has been flowing in the markets that again provide sort of echoes of what we saw during the dot-com boom and then bust. So I want to dig into that with you real quickly. First, I just want to apologize to folks if I sound a little congested. It's because I am. I'm still getting over the flu that I got coming back from my trip to Ireland. I'm going to do my best to soldier through this conversation with Michael, but I'm going to let him do the majority of the talking, which I'm sure folks are happy to hear about. All right, Michael. So I do want to also talk with you about bonds. It's been a while since we've done a bond update on this channel, and folks are always asking me, hey, can you get Mike Lebowitz on to give us an update? So if you don't mind, let's leave a couple of minutes at the end for that. But why don't you walk us through what you're seeing in the markets right now? And I believe it all sort of starts with the action that you're seeing in high beta, low profitability stocks, correct?
Right, right. So kind of coming out, so the market fell, about 15% in April, and we hit a low, and the market bounced right back up. Your typical V-shaped recovery that has become commonplace recently. And I was kind of, watching that, and you noticed that the rally back didn't feel quite the same as the rally in 2023 and 2024. And by that, I mean it wasn't the Mag 7 leading the way. It was other stocks, high beta, more speculative, a lot of companies not making money, but with promises of fortunes. And that as April kept going, that became more and more thematic. So I was like, maybe it's just me and I'm just noticing some of these companies up 20, 30% a day and some of these meme stocks. And, so I decided to kind of actually do the math
Right. And
and look.
sorry, Mike, but this is like meme stocks and like kind of the Cathie Wood type of tech stocks.
Cathie Wood stocks have been doing really well. Meme stocks are doing well. Anything related to crypto, Robinhood, for instance, Coinbase, uh, a lot of companies that have put AI into their names, and despite not being the Nvidias and the Microsofts of the world, but if you're AI oriented, the stock goes up. Again, similar themes as what we saw in the dot-com era. If you had internet in your name, or if you could somehow get dot-com into your corporate name, that was worth 40%, 60%.
Mhm.
So just seeing hints or echoes. Uh, and it's just over the last few months. Again, 98 to 2000 was almost two, it was about 2 years of high speculation. So I don't want to be alarmist either to say that this is playing out exactly like 2000, but we are starting to get that some of the similar speculative behaviors showing up. So, and this may be, so I wrote two articles. The first one really just talked about low beta and high beta and how a lot of it was really discussing the 98 experience. So just to set the timeline straight, from 95 to 98, we call that kind of the pre-boom period. That's where the internet was starting to become well known and people were starting to dream of what this wonderful internet could do for us. Little did we know in hindsight,
Mm.
the pros and cons. I mean, it works both ways, but yeah, I think we'd be flabbergasted to know what's evolved since then.
Right.
Then,
Undeniably transformative. Yep.
yes. In 1998, long-term capital and Russia defaulted. The market fell about 20%. And starting in roughly October of 1998, so long ago, October of 1998 to early 2000, the market just took off. And it was led by very speculative stocks. Before you got to that 20% decline, it was larger, profitable companies that were doing the heavy lifting. So you see the similarity. You got kind of your sort of Mag 7 between 95 and 98. Market drops as it just dropped because of the tariffs this time. And then it goes zooming ahead because of more speculative stocks. And then you have a bust. So 2023, 24, we had the Mag 7. That's all anyone could talk about, right? And what are those? The largest, most profitable companies. You know, that they account for what is it, a third of S&P earnings, 10 stocks or so. It's just crazy, but they're very profitable too. Then we had the tariff-related decline, about 15%. And coming out of that, it's not the Mag 7 leading the way anymore. It's the speculative stocks. So let me just show you with some graphs. I think it's easier than trying to talk through some of this. And I'm going to combine parts of my first article and my second article. My first article really focused on beta. And once I finished that, I really thought I should do more on the topic to help people understand how this may play out, but also to understand if it plays out like 2000 and we get a bust, where you might be able to hide. You don't necessarily have to sit in cash. Plenty of stocks did really well from 2000 to 2003. You just have to be able to rotate and actively manage your portfolio so that you're not stuck with the stocks that did well yesterday and poor today. You really want to just start assembling a roster of stocks that may do well tomorrow. Doesn't mean like a baseball coach, doesn't mean those players ever see the light of day. They never get to the batter's box or on the field. But having thoughts and a list of stocks ready is very helpful to anticipating what may come down the pike and noticing what's doing well and what's not doing well and when those start changing so you can be better prepared. So without further ado,
Super practical. Yeah. So I think folks are going to be really interested in this. So thanks, Mike. So as you're pulling up your charts here, let me just ask you to help me clarify for folks who might not be totally familiar with what exactly beta is. So when you talk about high beta and low beta, let me tell you my understanding of it, and then you can tell me if I've described it correctly or not. But
right.
a stock's or a securities beta is essentially its correlation to the general market. And so a stock with a beta of 1, if the market goes up by 10%, you would expect the stock more or less to go up by 10%. That would be a beta that's very tightly correlated with the market. If a stock is a high beta stock, 2, 3, 4 beta, then the market goes up 10%. That stock should go up 20, 30, 40%, right? Depending upon its essentially beta multiple to the general market. So that would be a stock with a positive beta correlation, correct?
Yes.
And then
So,
a negative correlation would be the market goes up. If I've got a negative beta to the market, you would expect the instrument to actually go down. And so a big part of your job as a portfolio manager is to try to build a portfolio that has different correlations to beta so that you've got diversification, right? You want some things that are correlated with the market, some things that are very correlated with the market, but then as hedges, you want things that might have a negative beta, correct?
Right. And you want to shift the importance of those factors over time. In an up market, you may want to shift to more higher beta. Market's going up and these stocks are outperforming to the upside. And conversely, you want to shift to lower beta when the market is going down so that you get less exposure to the market. And it's just all part of our, we talk a lot about rotations within sectors, within stock factors, and this is just another way to rotate. This is stock factors. So, Adam, let's look at some graphs. I think it's much easier to show visually than to talk through beta and some of the other factors and what happened in 98. And then we could do a quick comparison to today. This is beta. So I'm going to show basically three types of graphs, and you're seeing two of them here. And I'm basically breaking out the different time frames and how beta performed. And the data I'm using breaks out all of these factors by decile. And we're primarily focused on the first decile and the 10th decile. So that means the top and bottom 10% of stocks meeting those factors. So beta, it would be the top 10% of stocks with the highest beta and the stocks with the lowest beta. And in this case, the decile 1 is the lowest beta, decile 10 is the highest beta. So if you look at the graph on the left with the orange and the blue, and just again, focus on 1 and 10, you can see that from in orange in 98 to 2000, high beta was up 111%, and low beta was actually down a hair. It was down 0.72% over those 2 years. But now if we zoom out, going all the way back to from 98, so the boom, but also the bust to 2003, you could see that low beta stocks, despite going nowhere for those 2 years, were up 35%. Conversely, high beta, which were up 111%, rose a measly 2.65%. So pretty stunning. And you can see it on the graph on the right too, that during a boom, it was high beta. And as you dropped in beta down the deciles, it underperformed. So that was one of the dominant themes in 98 to 2000 was beta. You wanted as much exposure to the market as you could get. The riskier, the better. Um, so now let's move on.
All right,
And
and sorry, I just want to underscore one thing there because I've heard this before. I just want to make sure folks get it, which is sort of like when you're in a speculative mania, we'll say, and that's where things got by the end of the dot-com bubble, right? Think of it if you're a fisherman. I grew up in New England, and when the bluefish were running off the coast, you could just see them snapping at the water. And bluefish fishermen would say, you don't even need to put bait on a hook. You can just throw anything in that feeding frenzy and they're going to bite it, right? And so when you're in a speculative mania in the market, it is the most speculative stuff, meaning almost in some ways the junkiest of the junk, right? The stuff that is just the most specious tends to perform the best. Like the more craziness it has behind it, its narrative, the more people kind of want it when the animal spirits are running crazy like that. Am I
right.
underscoring the right thing here?
Exactly. It's really a gauge of sentiment. You could use this decile analysis for beta as a sentiment gauge. And my guess is it would track somewhat closely with other gauges of sentiment. Basically, investors don't perceive there being risk. And look, if there's no risk, you take the most chances, right? Why wouldn't you if there's no risk? But unfortunately, there's risk. And just because it doesn't appear like risk is knocking on the door, there's always risk that will eventually show up to the party. The cops always show up at the party, right? At the high school party. It's just a question of whether it's 9 at night or 2 in the morning.
Right.
So,
And this, I'll just mention this so you can address it later on as you explain all this, which is um, there's there are choices that you can make during this time. Like if you're seeing this type of mania as an investor, you can say, you know what, I've seen this movie before. I'm just not even I'm leaving the party now, right?
right.
Or you can use the Chuck Prinz logic, which is, hey, as long as the music's still playing, as long as the cops aren't here yet, I'm going to keep dancing. I'm just going to keep an eye on the door. Maybe I'm going to ask a friend to watch the street to see if he sees the flashing lights coming so I can be one of the first people out the door, right? And look, obviously one strategy is safer than the other, but kind of to a point I think you're making there, Michael, which is, if it's still 9 p.m. and the cops might not show up till midnight, like there's still money to be made if you want to play the game. Just understand it's a risky game and you got to put risk management in place. And so I always think back to John Hussman's quote with bubble markets. We said they force you to make a decision. Look like a genius now or look like a genius later, right? And if you decide you're just going to leave the party now, which is totally fine, just know that you might be gritting your teeth through a couple of months or quarters or maybe a year or more of idiots making a ton of money and basically laughing at you while they're just loading their pockets with easy gains. Right now, of course, you said the cops always show up, and so the key is to not be there when the cops show up or not be around when the bubble bursts. But I guess where I'm going with all this is um, there's a simplistic way to play it, which is just not to play, right? But there's maybe a more nuanced way to play it, which is not to go full bore, completely, crazy, blindly long, but to say, I'm going to still try to play some of what remains on the table here, but I'm going to do it in a risk-adjusted way so that if things start to turn, I've put in some safeguards to not lose my shirt. And I think that's what you're going to sort of talk with us about here, where there may be ways to play this and get involved in other different types of assets here, that if the party does turn, your exposure to the downside risk may be lower.
Right. And that's something you've heard Lance, I'm sure, over the last couple of weeks talking about managing the risk exposure, taking some profits from the winners, making sure you have diversification in some of those boring stocks like your Procter Gamble's, other stocks that have just been laggards. Healthcare is a great example of a sector that's really been lagging. So you don't want to go full bore, but you want to acknowledge this is the market we have to invest in. And it's not just going to flip overnight. There will be technical signals. You will sense the change in sentiment. And again, that could be tonight or it could be 2 years from now. So the job as we kind of get into riskier and riskier territory, or maybe we don't, but if we do, is get closer to the door. Understand how you get out. Understand where your risks are and where your risks aren't, and what you're willing and able to change when the time comes. And that's the best way to prepare for something that may or may not occur. And if it doesn't occur, so what? We're prepared, just like you're prepared for other calamities in life.
Yeah, and again, the thing I wanted to score here, and this is why I think what you're about to do is so important, is, Lance, more than anybody, reminds us that, look, if you're just constitutionally don't want to deal with this type of risk, absolutely, move into cash is fine. But what's really hard to do once you exit the market is to time your way back in. And what happens to a lot of people who do self-eject totally from the markets is once the market actually starts going back up again, then you start finding yourself stuck, right? Where you say, well, look, I was worried about valuations, but now the market's moved on me. Now I'm even more concerned that I've missed the gains and I'm going to get in and there's going to be a correction. So I'll wait for the next correction and then the market keeps going up. And you basically just miss out on, cycle after cycle of gains. And, Lance is, you know, points a lot to people who will still call you guys and say, like, I've been out of the market since 2008 and I haven't really been able to find a good way back in. So I'm not saying don't get out of the pool if you constitutionally are just uncomfortable with where things are. I'm just saying it's hard once you do, if you're all out, to have your plan to come back in. So following a plan like Michael's about to walk us through is a good way to stay in the pool but de-risk.
And be more comfortably do it more comfortably. You know where how to get out of the pool, and you know what you may invest in instead of panicking. Panicking is the worst thing you can do. So, Adam, we're going to move on to growth versus value. And on the top left, I'm kind of introducing a new way of showing this other than what we did with beta. And I created an index, so to speak. And I just took the ratio of the growth price to the ratio of the value price. Again, the top two deciles. And if you look from 2005 to 1995 to 2003, the trend is up and then downward over time, meaning that growth is underperforming value. But you can see from 98 to 2000, growth grossly outperformed value. And the two other charts show you something very similar. And I just realized one of my faux pas in these articles, an article is kind of has the graph and then words and then graphs, so you can kind of get away with my mistake. But when you line them up next to each other, what you'll notice, the graph on the top right is blue. It should correspond with the blue below, but it actually corresponds with the orange. So
Hmm.
don't I apologize. And if you take a good look at it, you'll notice the difference, which I just
We'll
did.
forgive you that chart crime.
Chart crime. So if you look at the bottom graph, I think that really says it all. It goes from 98 to 2003. And again, growth is on the left, values on the right. You could see that growth over that whole period, despite doing really well during 98 to 2000, was down 14%. Value was up 110%. So had you just stuck with value, you would have been miserable in 98, 99, and early 2000. You would have been much better off. And the graph on the top right shows that from 98 to 2000, growth did really well. That 10th decile of value actually did okay, but you can see 5 through 9 underperformed. And you can see the market was certainly preferring growth to value.
Yeah, and
Um,
an easy way to sort of say this is as folks get nervous, right? Once the speculative fervor starts ebbing, folks want, conservative safety, and that's where value is, right? So it's just the
Right.
pendulum swinging from essentially greed to fear, right?
Right. Exactly. Um, and then we can look at small cap versus large cap. And small caps are actually considered riskier, but more diverse. They're not as correlated with the market. They all have a lot of those companies have their own unique aspects, so their earnings don't necessarily sync as well with the economy as large cap companies. So the graph on the right is kind of what we've seen, right? That market cap, the highest market cap stocks did the best, and the lowest did the worst. But again, as you can see from 98 to 2003, you go through the whole cycle, small cap, the smallest of cap stocks, were up 200%, and the largest cap stocks were down a little bit. So, these charts are all showing you this is most profitable. Now we're going from least profitable to most profitable.
Hmm.
And you could see the same trend that from 98 to 2003, the least profitable companies did the best. They were up over 100%. Decile 10 is the most profitable companies. They were pathetic. So, but again, over time, it was the most profitable companies outperformed the least profitable companies. So you had a trend, you had an anomaly, and then you had a new trend. And the question is, what part of those trends and how did you play them is what really mattered for your returns. And this just summarizes it. The from 95 to 98, the market wanted the largest and most highly profitable companies. There's nothing wrong with that. That's a healthy bull market. You're putting your money in the Microsofts and Nvidias today, the companies that are really doing well, that are just kicking out massive profits, that have potential for massive profit growth. We can debate on their valuations all day, but they are highly profitable and they're proving it. They are investing a lot of money today, but they're also generating income today. Then we had the dot-com boom from late 98 to 2000. It preferred, didn't really necessarily want it, but invested in low profitability and the highest beta stocks. So it wanted risk. The riskier, the better. And I remember back in those days, and there was a stock a day that wanted to be in .com, that wanted to be involved in the internet, even though they were had nothing to do with it. The stock would be up 30 or 40%. And then we had the bust. And that's where the market kind of gravitated towards value, higher profitability, lower beta, smaller size, and value. So we can now, the table at the bottom kind of looks at what's been in favor in 2023 until the market fell off in April of 25, and then just over the last few months. And you can see that growth from 2023 to 25 and high size and high profitability. So the Mag 7, that's what's been driving the market. It's been extremely obvious what's been going on. We've talked about it. You've had numerous people, including Lance, talk about that theme over the last 2 years, right? But if you look at the on the right, it's high beta and profitability are doing the outsized returns. Growth value and size have been relatively on par with each other, but there's certainly higher beta is better and lower profitability. And these are returns over those periods. So, Adam, but what I want to stretch is this is a 3 month, 4 month theme. The question we have to understand is, will it develop into a full-blown mania like 98 to 2000, or is it just a theme that's going to kind of go away and we're going to get back to a more better market breadth where everything is kind of traveling with each other and this kind of fades? I don't know, but having this knowledge helps you appreciate whether we're getting more risky or less risky. And the more risky we get, the greater the odds that this cannot sustain itself and that you get a sharp, I'm going to say rotation,
Hmm.
because we don't need the market to collapse but we can have the S&P kind of go nowhere, but we can have these speculative stocks really get killed and value-oriented companies really rise in price. Again, because some of these market leaders, Nvidia is 7, 8% of the market, so is Apple, so is Microsoft. They are making money. They're making good money. So you could have a case where they really don't get killed and they can kind of keep the market higher, along with some of your more value-oriented companies like Lilly, like UNH potentially, or CVS, or some of those type of companies, while some of these high-flying names just get killed. So uh, that's what these articles were about. You could go to our website, check them out, and put words with these graphs and see if it makes sense to you. What I actually this morning I came with the idea. I was looking at UPS. UPS stock is the same price it was basically at the bottom of the co in March when COVID basically shut the economy down and people were just scared. They were scared to order stuff in, they were scared to leave their house. The economy was shut down. It's at the same price then as now. So I'm going to look at a few stocks, well-known companies, stocks whose prices are basically back to the same level as when the world was ending. And take a look at them and try to appreciate if some of these may be tomorrow's winners. They may be the value, the profitability companies that the market's going to be looking for when it starts shedding speculative stocks. So stay tuned for that one.
Okay. And Michael, when I talk to Lance every week, um, he talks about having a shopping list of companies that you guys are looking to add to, as on dips as valuations get a little less stretched. Do you have a list right now of those kind of
We do.
lower beta, high profitability stocks that if and when you think a rotation looks like it may be happening, you want to start increasing more into?
Oh, absolutely. We do. And we talk about them a lot. We talk about, a lot. We have rosters of all kinds of stocks because we don't know what's going to happen, but we want to be prepared and be following stocks and look to those stocks. Even if we don't buy some of the stocks, they're clues. They help us. We may never buy UPS. I haven't even done the analysis on it, but UPS may be perfect and we may buy it. But if nothing else, when UPS starts outperforming the market, that may be a sign that there's something changing. Why are investors reaching for UPS? And so that's, if nothing else, they provide an indication, and that's incredibly valuable.
Okay. Well, let me ask you this. So what, asking you to guess here a bit, or to speculate, what are some things that you think could um, puncture the enthusiasm for these high beta stocks? So, um, right now there's a lot of, yeah, I guess I would say the market sentiment is, uh, um, the AI trend is going to continue on steroids. So anything AI related, right, is going to do well. Um, the Fed is probably going to have to uh, pivot here at some point and start cutting. I think expectations for rate cuts are up substantially since the last Powell presser the other week. And so they're probably expecting, an additional goose from cutting rates. Um, what do you think would stymie that? What do you think is the kind of thing that would get somebody to say, you know what, I'm going to take some money out of this frothy high beta stuff and start putting it over in value?
It's an incredibly, I can't give you a good answer. I mean, I could lay out 10 economic scenarios or financial or war, or I could name a bunch of scenarios. But at the end of the day, what we find with kind of speculative errors with bubbles is that they just die because they just run out of steam, they run out of gas, and something happens. There's always some event that's what caused it. But that's not true. They just ran out of steam, and whatever event happened at that time, that's what caused them.
Gets the
If the
credit.
market
Yeah.
would have fallen 50% on tariffs, well, why did the market fall? It's 50%, but because of tariffs. But that's not the real cause. Not to say that there aren't things that can happen that can do that. There certainly are. But to try to anticipate it, it's hard. I think the one thing that kind of that I think a lot about is kind of the president's role in the economy, and the market has a lot of confidence in him, it appears. So, what could puncture confidence in the president and in his ability to keep the markets going, even though it's not necessarily him, but to keep the speculative fever? So that's something I think about. Like, what would change the much bigger, I know half the country hates him and half loves him. What would cause 75% of the country to all of a sudden start fading that and change the economy and really get people to understand there is risk. So that's one thing. But we could name potential wars, we could name tariffs, we could all kinds of things, Fed action. But I think what you just have to realize as an investor is that a speculative period will go on longer than you think it will, higher than you think it will, and seemingly pop out of nowhere, even though the market will assign something to help explain it.
Explain it. Okay. So let me ask you this. And look, there's a whole bunch of black swans out there that by definition, we're not going to know which one, emerges, because if we did, it wouldn't be a black swan.
Right.
Let me just talk to you about a white swan. Um, so your colleague in crime there, Lance Roberts, it has been pretty clear in the past couple of months saying, hey, there's more and more signs this economy is slowing down. He's not saying crashing. He's not saying going into recession, but he's saying slowing.
Mhm.
Um, and, we have interest rates and bond yields that are still quite high on a relative basis, relative being the past 20 years.
Mhm.
And honestly, they've stayed higher for longer than most people. Lance himself, when interest rates started, hiking, I remember him saying, "Oh my God, they'll never get above 3. The economy just can't take it," right? So obviously, the economy was more resilient in that standpoint than we thought. Now, of course, we shoved a whole bunch of trillions in there, so that didn't hurt. Um,
Right.
but the longer that we hang out in the sort of higher for longer environment, that is just this grinding weight on the economy. And we're going to get I think the latest retail sales at the end of this week, so we'll see how the consumer's faring there. But I think we are seeing more and more signs that the consumer really is getting near the end of. I don't want to be too extreme about this, but that they are getting uh, more and more weighed down in their ability to service their debts. For sure, we're seeing delinquencies
Right.
and defaults spike. Um, Consumer spending has been, pretty flat for a while now, and like I said, we'll see the latest numbers at the end of this week. Um, so, we're seeing bankruptcies, corporate bankruptcies, I think at the highest they've been in a long time this year. We are starting to see, layoffs pick up again. So what about just the white swan of just grinding economic, a grindingly slowing of economic growth here?
I think I think yes, certainly that can happen. You'd be a fool not to say that a weakening economy can't hurt the stock market.
Right.
But I
And would
think
it drive this rotation that you're saying from the highly
just
speculative to the value?
potentially, there's been ever since COVID, there's just been a boom in speculation. You see it in sports gambling, you see it in like the poly markets now, you see it in crypto, you see it everywhere. So a lot of that speculative investing is not based on fundamentals, right? It's based on hope. It's, that this company is going to be the next Nvidia or Microsoft. And maybe it will. Most of them won't be, but maybe it will. So it's more speculative. So I think a grindingly slowing economy, which we've had for a few years now, it's become a little more pronounced recently, may not do it. I think what you need is a sharper decline. So the unemployment rate spikes to 5% in 6 months or above. GDP is negative. Companies are truly laying off people. Right now, the labor market is it's like the real estate market. There's nothing happening.
Yeah, it's frozen.
Right? In real estate, except for you, there's no one selling, there's no one buying. Right? In the employment markets, very few people are getting laid off and very few people are being hired. And there's just it's just kind of status quo.
Can I add just one thing for you to address in your rest of your answer here, which is, again, your partner Lance, I think makes a good point, which is, to your point, the economy's been slowing for a good while. The reason why it hasn't mattered is because GDP growth on a quarterly basis was so high from all the COVID stimulus. So we've had this long mountain to come down, right? So
That's
even though
right.
it slowed a lot, it was coming down from a high peak. What he's saying now is okay, the danger we have now is now we're a lot closer to the ground, right? We have a lot less altitude. So, another blip downwards does put you in more danger of actually impact, right? And so to your point, hey, if the employment rate were to pick up by, a couple of dozen basis points or whatever, that's more meaningful now than it was a year ago or 2 years before then, right? So we are a little bit more vulnerable now.
Right. The unemployment rate is what, 4.2%?
Yeah.
That's still historically very low. It's either 4.1 or
I
4.2.
think it's 4-1 actually. Yeah.
May have upticked the last meeting, but it doesn't matter. It is what it is. Payroll growth is only averaging like 30,000 now. That's weak, but it's still not declining. ADP growth is averaging 30,000 or so. So again, it's kind of stagnating. The economy is
Okay.
stagnating, but it's not quickly moving.
Right. And by the way, unemployment rate's 4.2. I just checked. You were right.
Okay. So I think a sharper change in the economy and, probably in a weird way in the economic data versus the economy itself, because I feel like the markets are more clued on the data than the actual economy. I feel like a trader or investor can see all his friends getting fired and not care until he sees it in the employment data. And oh, it ticked up from 4.2 to 4.5. I'm out, despite seeing signs all around them that there's certainly weakness. Um,
Which is so funny because that's two things on that. One is it's the opposite with consumers, right? Consumers don't really care what the newspaper says. They just care what they see happening. My neighbor lost his job. I'm going to cut my spending then because I'm more nervous, right?
Right.
Wall Street, to your point, doesn't care until the BLS data suggests that it's an issue. Which
Well,
brings me to go ahead.
just real quick. Lance and I were hammering this about the job market. It's weaker than we see. And for the last couple of months, we've been pointing out other things like ADP, for instance, or
Right.
continuing jobless claims that are telling us there's something amiss between the BLS and those figures. And then all of a sudden we get massive revisions and BLS catches right up to those. So, again, and I think the Fed is really guilty of following the employment data way too much and not nearly enough on other sources of data.
Right, boots on the ground stuff. Well, what's so interesting about this is I have been bitching with Lance and you and many other people on this channel for years about the poor quality of the data, particularly coming out of the BLS. And was some of it politicized? Maybe, right? Probably. Was a lot of it probably caused by just the bullwhip effect of how distorted the data got during COVID with the massive amounts of hiring and firing and stimulus poured in the economy? Absolutely. I think their job is probably a tough job. Um, but we've all said, look, a lot of this data is almost useless. And it had been touted, though, by whatever administration was in place, as long as it was in favor of the current administration. And then now, all of a sudden, we've got Trump saying, this data sucks, and I'm firing the person who compiles this, the BLS, right? And so I'm just curious, like, what are your thoughts right now on just the value of this data? Because Trump's kind of, you know, just shouted that the emperor has no clothes. I think a lot of people would agree with him. Now, I don't think Trump's doing it out of the goodness of his heart to say, "Hey, I think this data is suspect." I think he's just saying, "I want the data to point in the direction I want it to point in." So he's got his own agenda. But I mean, are we in a like have we ever been in a position like this where we just don't trust the dials on our cockpit?
I don't know. I mean, we've always been of the school of thought where we're looking at all available data, and part of that is private data. So, for instance, like we've been warning about this coming slowdown, despite the BLS telling us we don't know what we're talking about. And sure enough, it turns out we do know what we're talking about. The BLS is using surveys, ADP is using actual data. So why the BLS doesn't, you want to Doge something, you get five good programmers and a couple economists and figure out how to use data from ADP, from paychecks, from whoever else does, salary services. Use that data. That's real data. Use tax withholding. That's real data instead of surveys of people and of corporations, which can yield any kind of result. No one's accountable for what they tell the BLS. It's same with inflation. I think they use, I'm going to butcher these numbers, but the BLS uses 100,000 data points. Sounds pretty legit, right? Till you consider that true inflation uses daily prices for, I want to say 1.7 million.
Right.
I'm butchering the numbers, but the ratio is about right. Why not just have a model like Trueflation that's just getting as many prices as you can and stop with the hedonics and stop with all the games they play and using averages and this and that and just have a number. If it's a little volatile, it's a little volatile. So be it.
So in 2025, when everything is digitized and our code base is very mature, we know how to do this. What is preventing all this, right? I mean, it seems like we could do this in a weekend almost.
Well, here's how many people work at the BLS. I don't know the answer, but I'm guessing it's a lot. And how many people are responsible for data gathering and reporting numbers? I'm sure there's other functions at the BLS, and I don't want to belittle it, but like I said, I think you could get a few developers, some AI, a couple economists, and just people that are generally aware of how data and economies work. You could say 10 people, and within a week, you could probably get the data you need to get you a more robust employment figure than what we have now. It's kind of pathetic that we haven't been shifting in this direction as our over the last 15, 20 years as our data analysis and computers and everything has gotten really uh, more advanced.
All right. Well, maybe that's the silver lining of Trump kind of lopping off heads here, where it just hopefully elevates, some of the antiquated ways of doing this, and in the kerfuffle, hopefully
And
somebody says, well, hey, look, there's a better source. Why don't we start prioritizing that?
well, and here's the other really tough part. This data, like trueflation, every day they put out an inflation number. This data should just be real-time data that's
I
just
know.
constantly flowing. And why tomorrow's CPI? Why is that such a big deal? That, it's already delayed. It's reporting on data from the middle of July, so it's already delayed by a month. And some of that data is using data from June, May, April. It's antiquated that a private sector service like Trueflation can do much better than the BLS, which is fine. But why does the market only care about the BLS? It's not the most pristine data. It's nowhere close to real time. And then if it comes in at zero point 0.2, that's good. If it comes in at zero point 0.3, that's bad. And given all the games that are being played with that data and just the frailty of the data itself, it's shocking that the market cares that much about a tenth of a basis point. And it's really not even a tenth because they round it. So it could be, less than that. It usually is less than that.
So interesting point, and then we'll move on. So, there's a lot of people who say, look, we shouldn't have a central bank in general, or the Fed's overstepped its mandate and had mission creep and all sorts of things, and we should have a market solution for setting interest rates, right? And I'm actually fairly sympathetic to that. But to your point, Michael, like, we could have all sorts of new real-time sources for a lot of the inputs that a central bank uses to make its decisions. So we could both, improve the inputs going into the system, and then we could have an intelligent AI that looks at them and says, hey, this is what the recommendation is given all the inputs that are coming in. We think policy should be X, right? And so, I mean, you could pretty much make a central bank kind of like an AI, based solution that maybe there's an FOMC that just checks the recommendation and debates, okay, do we want to do what the AI says? But it could be a lot more simplistic and get back to like what Axel Merck, who comes on this channel with me every time the Fed speaks to make sense of it for all of us. He's always criticizing the Fed for not having a framework. He's like, if the Fed just said, look, this is the rule set that we use, and this is generally when we pull the lever this way or we pull the lever that way is when the data is here or here, we could all have transparency into the system, right? Well, if inflation's here and the unemployment rate's here and these are the trajectories and these are the inputs, the market would pretty much be able to anticipate what the central bank decision is going to be because everything's clean and transparent and up to date.
Mhm.
Do you think we're probably moving to that type of solution just on a kicking and screaming basis?
I think in order to get to that solution, you need data sources that the Fed will trust. I think there are data sources, but they're not apparently using them. So, it starts with a good, this is model-based Fed policy, which has been argued for decades they should be doing. And even on the Fed site, you can see where there are Fed models versus what the Fed's doing. Like they even show some of these Fed models. So, I just think now's the time. Let's just redo the Fed. Let's rethink what the Fed is and isn't. I think I'm sort of a libertarian at heart, but I do think there is a time and a place for the Federal Reserve.
As like a
But
lender of last resort, right?
a lender of last resort, exactly. And, manage the daily flows like in some of these overnight markets that are incredibly important to the economy, to the financial markets, to the health of the banks. Regulating some of the banks someone has to do it because we know what happens when no one does it. So there is a role, but being, the almighty with the power of Fed funds And whether whatever they do is political or not political, it's based on judgments. They've been proven to be wrong over and over and over again. Bernanke in early 2008 saying everything's okay. Powell with his foot on the gas in 2021, despite the fact that supply was shut down and demand was starting to pick up like crazy. I mean, they kept interest rates way too low through the Bernanke and Yellen era. I mean, you can go back in time too. They flooded the market with cash before Y2K for potential technical problems with the turning of the calendar. That just fed that bubble we were talking about earlier. Fed has made a lot of mistakes. So if you can get to more of a model based with better data sources, that would be much better. And ideally, look, I'd rather the market set its own price for overnight money, and the Fed just comes in when it kind of gets out of bounds a little bit. But you have to disrupt the whole power structure. Unfortunately, in Washington, where I'm at, people love power, and that's both sides of both political parties. They love power, and everyone involved loves the power. So they're not likely to cede power to anyone, especially a model.
That and there's the expression in academia, which I think also holds very true in government, which is uh, progress advances one funeral at a time, meaning just the old guard does it its own way. They have their own preferred data sources, things like that, and they don't
Right.
really give it up. And so it's only after the new crowd has come and brings
Right.
their new way of doing things with them, and they eventually displace the old crowd basically through dying off.
Right.
All right, so look, fascinating discussion. Would love to continue on it with you, Michael, but I got to land the plane, and it's providing a good segue into the bonds discussion. So um, the bond market's kind of been, ping-ponging back and forth in this range, low fours, 4.5 for a good while now. We know that the administration would love nothing more than to punch below four decisively and to get those longer term interest rates down. Um, what's going on here? Is the bond market basically just kind of in a wait and see to see if tariffs are going to have any inflationary impulse that the Fed is going to have to react to, um, or just, hopefully at some point the Fed says, nope, we're not worried about it anymore. We're starting to cut rates, and that's going to start bringing yields down all across the curve. What do you think?
I think the tariffs are just the bearish narrative of the day, right? There's just been a bearish pull over bonds for the last couple of years, and we've talked about the term premium and how it's been elevated now for 2+ years. So what's dragging on bonds is the deficit. I know the deficit's not the issue anymore. It's tariffs. It's supply of treasuries. It's whatever it is. The market's just latching on to excuses to be bearish on bonds. Um, what drives and what's important to recognize is what drives what bonds. So, what the market do today? And your answer would probably be, oh, the S&P was up 12 points. That's great for the S&P, but there's 500 stocks, and I bet you some were up 5% and some were down 5% and all points in between. So when we talk about the bond market, it's a little misleading to say, oh, the 10-year yield fell 2 basis points today because it doesn't tell you what the 3-month bill did or the 2-year or the 30-year or all points in between. So when you kind of look at bond yields as a spectrum, what you find is that the very shortest of bonds, so today's August 11th, if we look at a bond maturing August 18th, next Monday, it's a 1 week bill. That yield is solely a function of liquidity. Where will overnight Fed funds trade for the next 7 days? The Fed's presumably out of the picture. They're not going to, their next meeting's not till September. So it's a functional liquidity, and that bond yield is barely going to move, if it does move at all. Then you look at a 30-year bond. It's the opposite. It cares about what the Fed's doing, cares about inflation, cares about deficits, it cares about the term premium, it cares about money flows, it cares about a lot of things. So the long end is affected by what the Fed's thinking, but all these other factors. So when you're deciding where you want to invest, if you want to invest in bonds, it's not just by the 10-year, because that's what everyone talks about. You go on CNBC, what the 10-year yield do? You want to you want to make that investment based on I have a lot of faith that the Fed's going to cut rates, but I have no faith that the narrative is going to disappear and all of a sudden bond bulls or bond bears are going to get bullish. So in that case, you want to kind of stay at the fronter, the front end of the curve.
Yeah, the shorter
Um, Right. If you're in the camp that, look, this economy is weakening and I think we're going into a recession and I think that these bond bears have been kind of proven wrong on a few things and that they're going to flip and as money market yields fall, the chase for yield is on and those narratives go away, then you want to be in the long end. And as those factors change, you want to adjust your duration and how much you own. So about a month or so ago, we sold a little bit of our 7 to 10 year duration bonds and we bought kind of in that 5 year, 3 to 5 year sector. And we've gotten a lot of questions on it. Why do you lower duration if you think rates are coming down? And we do think rates are coming down. What we did was we lowered our duration, but we bought a little bit more of them. So on an equivalent basis, we didn't really drop our duration all that much because we added more bonds to the shorter maturity. And what we're really saying is we have a little more confidence that the Fed's going to be cutting rates and probably more than the market thinks. Because when we did that trade, the market was thinking maybe one cut by the end of the year.
yeah.
Now we're up to three or four or whatever it is. And I've even heard, kind of the word 50 basis points at the September meeting being mentioned. So, we've quickly turned from maybe a cut if we're lucky to could be three or four by the end of the year, if not more. So you can kind of skew your bet a little bit. I'm going to bet a little bit more on the Fed, and I'm still worried that those narratives just won't go away. They're just persistent, those bugs. So that explains kind of our gentle shift. Not a big shift, but a gentle shift towards reflecting that view.
Okay, so let me just make sure I understood what you said there. So you do think the Fed is more likely to blink here and start cutting. You're not entirely sure that the bond bull bears are going to give up their worries. And so uh, because the Fed controls the short end of the curve and not the long end, you're buying more in that sort of, you know, mid-tier duration because it'll be
Right.
influenced more by the Fed's uh, cutting than the long end will. So you want to pick up your pop there from the Fed cut. Let's say it plays out that way. Obviously, you're going to make your future decisions based upon what the reality is on the ground at that point in time. But would your expectation be to then start moving out further on the curve, thinking that the bond bears will eventually have to capitulate if indeed the economy is slowing and the Fed is cutting for a good reason?
Potentially. I mean, we'll see as the curve steepens. So as shorter term yields fall versus longer term yields,
Yep.
the the reward, the incentive for moving out the curve gets bigger and bigger, right?
Right.
If the Fed drops rates to 2%, your money market is 2% and your 2 year bill is 2.5%, and it's still four and a quarter or so, give or take, for a 10 year, people are going to want to start locking that in.
Yep.
So they'll start buying those down. And we've seen that whenever we kind of get these short-term peaks in yields, there's some really strong buying from the pension funds, from the insurance companies, from the true end users, not speculative people, but investors that are more than likely going to hold these bonds. They want to lock in those yields. So that could be a very bullish impetus that could get long-term yields down significantly if we're going into a recession, or even if just the Fed's going to cut. But at the same time, you could make the argument, oh, the Fed's cutting, that's very inflationary,
Hmm.
regardless of whether it is or isn't.
Yeah, absolutely. Okay, so you're raising a really big question, which I wish we had time to do justice to, and so I'm going to have to flag it for later. But there's a lot of people out there, and I assume a lot of people watching this video, and I'll include myself in this group, who have really taken advantage of the T-bill and chill trade over the past couple of years. So if that trade is potentially at risk of going away in the relatively near future, like let's say the Fed cuts 4 times this year, right, and then keeps cutting into next year, all of a sudden, to your example there, if short-term rates go down to 2%, right, or less, it's the attractiveness of that trade goes away. And so you have to ask yourself, what do I want to do? Right? Do I want to ride that down and just stay in T-bills but get a lot less for it? Do I want to start deploying that into something else? Maybe some of these low beta, high value, high profitability companies that you were talking about earlier. So I think a lot of people are going to be faced with a choice of what do I do? And doing nothing is a choice. That's a choice to ride the T-bill and chill trade down. So um, unfair, but do you have any quick thoughts about that? And obviously, this is something that somebody could. I talk about the free consultations on this channel. This is something that somebody could reach out to you guys at RIA and just say, hey, look, this is my situation. What options make the most sense for somebody like me? Correct?
Yeah, please do ask us. I would be happy to help you. Look, I think the answer I'm going to give you is very similar to what I told you with the speculative stocks. Have a plan. Start doing trades now. Like, one of our trades over the last couple of weeks, we've done a couple times is we've taken profits and we've used some of that money to put into some of our more conservative laggards. So we are doing a very slight defensive rotation. So if you have, 90% of your money in the T-bill, why not take 10% out and buy a 1 year or a 2 year? At least lock in some longer rates. Look, and if you're wrong, you're wrong. And T-bill rates stay where they are, you're wrong. But if T-bill rates go down, if the Fed cuts all the way down, the Fed always cuts more than the market thinks. And that's really important to understand, both going up and going down. They cut or raise more than the market is predicting. So the market's predicting 4 by the end of the year. Maybe what if they cut by 6? What if we're talking about Fed funds with a 2 handle? Then that would be by December, January. Not expected, but if the economy really slows down, that's probably where they're going to be. And at that point, the 2 year bill will be all the way down there with it. So start diversifying, moving out the curve a little bit. That's kind of, the message. It's you don't have to do everything at once, and if you wait, you're never going to top tick the market, and if you wait too long, it's too late. So do a little bit now. If you own 100% of Cathie Wood's ARC portfolio and you've done incredibly well over the last few months, sell 5% of it and buy, pick a conservative stock, buy Berkshire Hathaway, diversify, protect some of the money you've made. You're never going to nail the tops and the bottoms, but you can start adjusting as you get closer to tops and bottoms.
All right. Really good advice. And obviously, the best answer is one that takes the person's individual situation into account and the other assets they own, their risk tolerance, their goals, their time they have left in the market, all that kind of stuff. Which is why, folks, I always recommend that unless you've got a lot of successful DIY experience, you bounce these ideas off of a good professional financial advisor, ideally one that takes into account all the issues that Michael has talked about for us here. All right, Michael, well, look, I can't thank you enough for today. It's been a great discussion. I'd love to, next time I have you back on, it'd be great to really roll up our sleeves and talk about kind of the end of T-bill and chill if you're willing to really, get into the meat of that with me. But thanks again for stepping up to fill Judy Shelton's shoes. They're big shoes, and you've done a really good job today of stepping into them. Folks, please show your appreciation for Mike doing that by hitting the like button and then clicking on the subscribe button below, as well as that little bell right next to it. Yeah, if you would like to get some help in figuring out how to position your portfolio for the end of T-bill and chill, highly recommend you consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses, maybe even Mike himself and Lance there at RIA. To do that, just fill out the very short form at thoughtfulmoney.com. Only takes you a couple of seconds, and these consultations are totally free. There's no expectations involved. It's just a free service they offer to be as helpful as they can to folks. Mike, thanks so much, my friend. Always great to see you. I'll let you have the last word here.
Just don't, this goes back to politics. And I was with some friends this weekend and they were like, how can you, they were on the liberal side and they were like, how can you be invested in this market? How could you trust Trump? And my response was, as an investor, you have to separate yourself from your feelings, from your politics. And you have to follow the trends, right? Do I think this high beta trend is sustainable? No, I don't. But it is what it is. And that's the market we have to play in. And this is the political system that we have, whether you love it or whether you hate it. You have to dismantle your investment decisions from it. So I urge you to just try to step outside of your own box and really just evaluate the situation for what it is and not what you think it is or how you favor certain things. So,
Very well said, my friend. All right, Mike, thanks so much again, and
yep,
look forward to having you back on the channel again soon.
yep, absolutely.
All right, and everybody else, thanks so much for watching.
We've not only taken out the big problem that we had with silver at 3,300. There was such strong technical resistance. There was also technical resistance at about 35, but it just sailed through there. And we'll go back to a daily chart so we can get a better idea of what we're looking at. $40 is our next anticipated level. We could encounter resistance. I'm not really expecting any real resistance there. Our studies right now are looking for $42 on the upside,
Right.
and it is based upon not a daily, but rather a monthly. And so that's the thing. You can, as I said, we've got to go way far back, really compress this chart before we see the last time. Silver seems to have locked on it, but the last time was 2014.
Silver has broken above the long-standing $35 resistance, reaching levels not seen in over a decade due to tight supply and strong industrial demand from sectors like solar and electrification. Prices have climbed near $39 to $40, with analysts targeting $42 next and the potential for $45 by 2026. Institutional forecasts by Bank of America, Citigroup, Saxo Bank, and others also converge on a silver price around $40 by late 2025 or early 2026. Gary Wagner, a seasoned technical analyst and the host of the Gold Forecast, explains that silver has recently surged past significant resistance levels, reaching its highest point in over 13 years. This upward momentum is attributed to a combination of factors, including strong industrial demand, particularly in renewable energy sectors like solar and electric vehicles, and a persistent supply deficit. As of August 30, 2025, silver is trading near $37.95 per ounce. Silver has been trailing gold but is now starting to catch up with impressive momentum. However, gold has built strong momentum, rising from $2,300 in March 2024 to over $3,500 before consolidating into a symmetrical triangle. This pattern often leads to breakouts in the prevailing trend, which remains bullish. After pulling back to the lower channel, traders went long near 3,410. A close above 3,473 would confirm the breakout, opening the door for a new leg higher. Despite recent gains, the setup points to more upside ahead. As we dive into the video, remember to subscribe and tap the bell icon so you never miss an update. We value your thoughts, so drop a comment below and give us a thumbs up if you enjoyed the content.
Lagging behind gold, obviously. Yeah. This, of course, is a daily. And what I was looking at, and I'll flash it back, was a monthly. So you can see the performance this month from 37.48 up to 39.72. Quite a move. 2.42%. Excuse me, $2.42, up 6.5% over the month. And the thing is that this red line was drawn in yesterday because that's where silver had closed yesterday. And so we have not seen these prices really since February 2013. It's definitely the bullseye target right now. Could it go higher? Yes. Yeah. It is reacting in a much more sensitive manner to follow gold, which it was not. And now we're seeing it play catch up, so to speak. So I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there, 42.30. And that's the first target. If it breaks strongly through there, 44 would be the next upside target above that. A daily Japanese candlestick chart. And of course, I'm using a combination of studies, but basically trend analysis, Elliott wave, and pattern recognition, such as this symmetrical triangle that we're witnessing. And what we notice is we've had a runaway bull market. If we move it back a little bit, you can see that as you know, we're sitting at 2,300 in March of 2024. Not too much to move it to 3,200, 3,400. So we've got 1,000. And then it runs up to the all-time record intraday high, well above 3,500. Viewers, I am looking at a futures chart. So the numbers will be a little bit different than spot. Yeah. And then we knew, at least our model predicted, we were headed for a correction, and that's what I thought we would see. But typically in a correction, you get something like an A, a B, and then a C, and then you go back to the motive phase, a 5 count of bullish waves, 1, 3, and 5. In between, you get corrective waves 2 and 4. But what happened was when we saw the market go up and hit this top, we had already drawn in the compression triangle and come down. We realized that this was not unfolding as a simple ABC, but something a little bit more complex. This is simply called a symmetrical triangle. The idea behind the symmetrical triangle, of course, is you're going to have a series of rallies followed by a series of shallow corrections, shallow rallies, until you typically get to the E wave. Following the E wave, as the model predicts, and not so well this time, you get what's called a thrust. A thrust is simply when prices break above, that's the wrong one, but is simply when prices break above the resistance line and you get that hardcore breakout. We certainly didn't see that. And so we watched gold go back into the channel. Let me just kind of blow this up a little bit. Go back into the channel and trade back down to the lower end of the channel. At this point, we realized since it did not occur here, meaning a thrust or a breakout, this would be, if it's going to do it at all, this would be the time. This is when we got our subscribers long at about 34.10. We had enough confidence that it's probably not going to break to the downside because, Jeremy, a symmetrical triangle doesn't necessitate a breakout to the upside or the downside. Either can happen. Typically, we see it go to the prevalent trend direction, which of course is higher, and that's exactly what we saw. Now, today, we're right at the resistance line. I hope our viewers can see it. I'll blow it up a little bit more, but as you can see, we've just gone over that a little bit. And so this was the breakout that I have been waiting for. And I believe that a solid close above, let's call it 34.73, will signal that we are going to see a strong breakout to the upside, moving gold substantially higher, even though it's already traveled from 33.58 to 34.78. So it's gone a significant amount, but we think that there's a lot more room to the upside right now, as long as we get an effective close above this resistance line, which it clearly looks as though that's a highly probable outcome.
Gary highlights that the US dollar index is exhibiting a notably bearish technical outlook, influenced by its performance relative to key moving averages. Recently, the dollar has fallen below both the 50-day and 200-day moving averages, signaling a weakening trend. The 50-day moving average, currently around 98.1, is acting as immediate support, while the 200-day moving average, positioned at approximately 102.7, remains well above current prices. Additionally, the 50-day moving average has crossed below the 200-day moving average, forming a death cross, a classic bearish signal in technical analysis. Gary thinks that this alignment suggests a shift toward more bearish market sentiment. Furthermore, the relative strength index is hovering near neutral levels, around 50, indicating a lack of strong momentum in either direction. Covering all the scenarios, We can say that the US dollar is currently facing significant technical headwinds, with both short-term and long-term moving averages indicating a bearish trend. Traders and investors should remain cautious, monitoring for potential further declines if the dollar fails to reclaim key support levels.
This is our simple 50-day moving average, and that's what we would look at for short-term market expectations. If it's above the 50-day on a short-term basis, we are in a solid bullish demeanor. The 100-day is intermediate, and then the long-term is the 200-day. And so I've highlighted the 200-day is in red. Green is the 50-day. It melted through the 50-day, came down and melted. You see how exaggerated the moves were on the days when it broke through the 50 as well as the 200. And so that's significant, because what that tells us is that on a technical basis, on a very long-term basis, the dollar is extremely bearish and has more room to the downside. In terms of targets, if it continues to drop 95, I'm basing that on a Fibonacci retracement data set that beginning of May at 89, up to the record top that we've seen recently at 114. And then the important numbers are drawn in. This is the 78% retracement. This, of course, is our starting point. As you can see, this is the 38. This is the 50. And the fact of the matter is, we're probably close to the, we've even broken through the 61. And in terms of corrections, 61 is a very deep correction, but acceptable. 78 is acceptable, but actually fairly rare. And a break below 78 would mean that we're not looking at a simple correction, but a flip from a corrective expression in a bullish market to a fully bearish market. If we broke below 78, that would signal that. You notice also, when you look at this chart, the 61.8, it comes down, it tests this area, it pops back up, and look, it finds resistance at the 50%. Then it comes back down, breaks through it, and you can see all of the attempts that came in. Let's go ahead and widen this. All the attempts that came in to break back above that, and all of them were unsuccessful. And because of that, that tells me the dollar absolutely has a higher probability of going down than going up.
Yeah.
And the next target, as I said, would be about 95 on the dollar index.
Silver is showing strong bullish momentum, breaking key resistance levels and catching up with gold, while gold itself remains in a bullish breakout setup. Conversely, the US dollar is under technical pressure, with long-term and short-term indicators pointing toward further weakness. These dynamics suggest a favorable environment for precious metals, though investors should remain vigilant to potential market corrections and shifts in momentum. How might the dollar's ongoing weakness impact silver and gold prices in the coming months? What are the key levels investors should watch for to confirm continued bullish momentum in silver and gold? Please share your thoughts in the comments section below. We'd be delighted to hear them. Don't forget to subscribe for more videos and give this one a thumbs up if you found it helpful. We appreciate you sharing in our adventure.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher. The price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200. Would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really relevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds, 100 to 200. Would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it, we have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay, still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Ooh boy, you break through that, and I'm gonna blow the cork off this thing." The spread is about to do that, I think, and when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? You know, do you remember the movie The Big Short?
Yep.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table, okay? That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Mm-hmm. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. Annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it, okay? And that's a good excuse. Oh, well, the industrial demand, well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows, it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. as I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid. It's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up, because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt, and that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75. While the long-term targets of $20,000 for gold and $500 for silver remain highly speculative, current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982. With the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end is going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982, and the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, oh, you've already pushed it out again. No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions in derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough,
Sure.
We didn't go through a bear market. So that's what's unusual. And I think that's where people are going to probably get it wrong is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run. And I'll be at that point contrary and saying, no, this is the top, we're close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative. And it comes, my reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global debt. And I realize a lot of it's sovereign, but 330 trillion in global debt and quadrillions in notional value of derivatives. Never been here before. Never. And derivatives are leverage on markets. Debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of Ukraine. But I stayed with it at 130 and said, we're going back to 85. And then once we broke 100, I said, we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. It could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand. And we've rationalized down supply, the mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years, whereas having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, how might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.